Meantime, we've got some news from Starbucks this morning. Let's get right over to Kate Rogers. She's got the latest on that. Hi, Kate.
Hi, Becky.
Starbucks is making headlines after announcing plans to close a number of underperforming stores in certain U.S. cities. But what's really going on behind these closures? And more importantly, does it matter for Starbucks stock? Let's break it all down. First, the facts. Starbucks has confirmed that it will be shutting down a set of locations, mostly in high-crime, high-cost, or low-traffic urban areas. These stores have been facing challenges like rising operational costs, safety concerns for employees, and declining foot traffic. But at the same time, Starbucks is not downsizing as a brand. It's actually planning to open hundreds of new stores, especially in suburban areas, drive-through formats, and international markets. So why is this happening? The shift comes down to two main drivers. 1. Starbucks is adjusting to post-pandemic consumer behavior. Customers are ordering more through mobile apps, delivery, and drive-thrus, and less through traditional in-store visits in urban centers. 2. Management wants to improve efficiency by focusing on locations with higher profitability and stronger long-term demand. Now, let's talk about the impacts. For employees, this restructuring could mean some store closures, but Starbucks has said it will try to relocate workers to nearby locations, and with new store openings coming, the net effect on jobs may not be negative. For customers, it may mean fewer walk-in options in city centers but better access to drive-through and pickup-focused stores. Starbucks is doubling down on digital orders, app rewards, and customized beverages, so customer experience is becoming more streamlined. For investors, this is where it gets interesting. Store closures might sound negative at first, but they can actually improve margins by eliminating underperforming locations. At the same time, expanding into faster-growing suburban and international markets could boost overall revenue growth. To give you a scenario analysis. In a bull case, Starbucks successfully shifts to a more profitable store base, margins expand, and international growth, especially in China and India, drives strong double-digit revenue increases. The stock could see a significant re-rating higher. In the base case, Starbucks absorbs some short-term costs from restructuring but gradually benefits from improved store mix, steady U.S. demand, and international expansion. The stock delivers moderate but consistent returns. In the bear case, store closures hurt brand reputation, customer loyalty weakens, and global growth slows due to economic challenges. Margins shrink, and the stock underperforms. Right now, analysts are split, but many see Starbucks restructuring as a proactive step, not a sign of decline. Closing weaker stores while opening stronger ones is often a sign of smart long-term management. So, what's the bottom line? Starbucks is not going away. It's reshaping itself to meet new consumer habits, strengthen its financial position, and prepare for future growth. For long-term investors, this may be a moment of uncertainty, but also one of opportunity. If you found this breakdown helpful, don't forget to like this video, subscribe to Digiwallet Hub, and hit the notification bell so you never miss an update on stocks and market insights. And tell me in the comments, do you see Starbucks restructuring as a bullish signal or a warning sign?